Overnight, stocks reopened for trading in mainland China after the week-long Lunar New Year holiday. The Shanghai Composite fell by 7.7%. The Shenzhen Composite was down by 8.4%. Eunice Yoon is covering the coronavirus outbreak in Beijing. But we'll start with Matt Taylor in Singapore on this sell-off. Matt, good morning.
Hi there, Becky. Good morning to you. Remember, it was January 23, the last day that we saw, of course, the mainland China markets and Shanghai, the Shanghai Composite, having its biggest one-day decline since August of 2015 and the biggest one-day decline that we've seen after a Lunar New Year holiday in 13 years. It opened down by more than 8% and barely managed to recover any of those losses, ending down 7.7% or wiping off about $420 billion of market value. Around 2,500 stocks trading limit down of 10% as well. The Chinese central bank moving to allay some of those concerns, saying that the sell-off perhaps might have been a little bit overdone, also saying the impact from the virus will only have a temporary impact on the economy. The stock market plunge, they say, was driven by some irrational factors or even panic triggered by the so-called herd effect, is what authorities were saying. We did see a lot of stimulus. Authorities, though, moving to pump in a lot of liquidity to try and support the market and the financial system. The PBOC injecting around $174 billion into the financial markets and also providing support by unexpectedly cutting the 7- and 14-day reverse repo rates by 10 basis points each. There's also a lot of talk now that the loan prime rate, or the LPR, this is set a little bit later on this month, around the 20th of the month, could also be cut. The Chinese yuan weakening to its lowest level since December, and as you can see, falling below that 7 level. Of course, we're used to seeing it sitting right around 680, 690, but weakening beyond 7. And we saw some fairly big moves when it came to the currency as well, in the order of about 0.8, 0.9%. But yeah, a 7.7% drop for the Shanghai market today, of course, playing catch up since the 23rd of January. Back to you.
Hey, Matt, I had seen some reports suggesting that China's securities regulator was actually telling the brokerages, the proprietary traders, that they aren't allowed to be net sellers of equities this week. Is that true?
There were some reports suggesting that big fund managers, big mutual funds as well, really shouldn't go in and sell those stocks if they really didn't have to. So this all happening right around the time the market opened, about 9:30 a.m. local time this morning. We did, of course, see the market plunging sharply, more than 8%, 8.6%, in fact, was the low point of the day for the Shanghai Composite. As I said, recovering, but if it hadn't been for perhaps some of that liquidity being pumped into the market as well, given that we saw so many stocks going limit down, 2,500 of them, that 10% move down that they can only do in one day, things could have perhaps been a little bit worse out there.
Yeah, it suggests that maybe the sell-off wasn't overdone if you have all these stocks that limit down for the day.
Right. You know, it's not without precedent for the Chinese government to insist on, verbal intervention and to tell brokerages. We've seen them do it before, right. So it wouldn't be a surprise. Another thing I would say is, you close your markets for an entire week. I mean, they do that by design, right, for the Lunar New Year. We have rules in this country against that because you want liquidity available for when people. So you're going to get a massive move.
So you don't want panic selling.
You want the market to be able to respond in real time and investors to respond in real time, rather than making everybody wait for an entire week before they can actually get into the market. Remember, after 9/11, our stock exchange worked very hard to reopen because they felt liquidity was an important mandate.
Sometimes you want a weekend, or you want time for people to actually digest this. But the question is whether it would have been worse the other way.
Oh, I don't think so. When you can respond every single day, absolutely.
But no, but sometimes you want the reason sometimes people want from a Friday to a Monday is.
That's why you have a limit down, right? Okay, it goes down 10%. Everybody, take a breather. We're going to shut down for a few minutes. Relax. And then bring it again.
You can argue that you want it to be able to be on all the time or not. The limit down thing, to me, goes straight to the argument that actually you don't really want the markets to work exactly as
It's to assuage concerns like yours. Whether limit down works or not, I don't care. But you should not have your market closed for an entire week.
I do like limit down. I have to say, it's just to let the steam blow off eventually and to have an ease and take it off. We would have it slow down for a few minutes and see what happens.
Right.
So that it's not like crazy trading that's coming from computer algorithms and things, too.